Hey all, this is Dr. Frank Chopatini with the Church of Rational Truth. I thought today that we do a little bit of a different kind of talk than we normally have been doing. The last few have been very philosophical. They're not very like hard sciences or hard factual talks. But I figured this might be a nice change of pace to talk about something that's more concrete, something that's more of just actual learning about a topic rather than more philosophical topics. So I had a talk with a patient yesterday about stocks in the stock market. And so I figured, hey, that's a good topic to kind of go over in a general sense for people who don't know much. If you already know about the stock market, this is going to be very boring talk, or it's really not going to add anything. But for members out there, followers out there who want to know a little bit about the stock market and really don't know anything about what is it, what does it do, why do people care so much about it, this is a very good intro talk. So first off, what is the stock market? The stock market is basically a trading platform for people to be able to buy and sell portions of corporations. And I'm going to be very specific with the term. I'm sorry if I screw up the terms in the future. A lot of people will switch up companies and corporations and not really know the difference between the two. But it's a place where people can buy and sell portions of corporations called shares or shares of stock. So basically, how a corporation is different than a company. Companies are usually owned by members. It's usually owned by specific people who own a certain percentage of that company, versus a corporation. Their structure is that the owners are not necessarily individuals or other groups. It's shareholders, people who own specific parts of the company. It's basically the same thing, but the main difference is a corporation is usually made for some business that might have hundreds to thousands of people who own it. Some could have millions of people who technically own it, versus usually companies are usually owned by a couple of people. They don't need to have shareholders, because if you only have 5 people, you don't need to split up the company up into millions of little bits. Versus corporations, think of them as one share of stock is just one tiny bit of that corporation. So with the stock market, people can then take those little bits of a corporation and buy and sell it for a price. And there's a lot of companies that do business like this. Why do they have a price? How do you value a stock? Well, basically, it is a small percentage of the company. And if you take all the shares of stock and all the different types of stock, which is going to be a bit more than we'll go over in this talk, but if you take up all the total number of stock in a company and figure out how much the company is worth, you can kind of go backwards and figure out, okay, this is how much I think the company should be worth per share of stock, or how much the company is worth in total. So if I have 1 million shares of a company and the shares are all valued at $1, you could say that that company is worth $1 million. And that's kind of an easy way to ballpark how much a company is worth. Or, I mean, that's a very literal way of saying how much a company is worth. The way it works is it is literally a market. So people are out there buying and selling at specific prices. People will list a buy price, or the price that they're willing to buy a stock on, and they also have a sell price. So there's people always willing to buy and sell. And if you actually look, those are the bid and ask prices on a stock. That is what is currently someone trying to buy it at the highest amount that someone's trying to buy it at. And the ask is the lowest price someone is trying to sell it at. The market price is the price where that stock just sold. It is the last time that it sold. It is usually either the bid or the ask price, or somewhere in between. Basically, it's 2 people actually went, okay, I'm going to exchange this amount of stock for this price, and that is the current market price. This is also why it fluctuates. The market price when the market is open just changes second by second based on who is the last person who made a trade on that stock. A lot of people, wonder, why does the price vary? Why does it change? Well, it changes because different people have different valuations of a stock. Some people think it's more expensive. Some people think it's relatively cheap. But what will happen is the price will meander until it kind of gets to the point where, people think that is about the price of it. If someone thinks it's more expensive, they will buy it and push the price up. If someone thinks that it's overpriced, they'll sell it and push the price down. But basically, when those factors kind of even out, it reaches a more stable market price. But the problem is every day, the valuation of a company can change. Things change every day. Companies do good, companies do poorly, news comes out that changes outlooks on a company. And so that's why a day-to-day company can fluctuate, 2 to 5% in value. Sometimes you hear huge swings in value because there is something surprising about a company that is either really good for their business or really bad for their business. And so as soon as that comes out, the stock price, adjusts to take into account that news or that information about the company. A lot of people, especially people who are new to buying and selling stock, they think that it's similar to gambling, or they're like, well, it's just like a gamble. Who knows what's going to happen with your money? And I want to say that is kind of true and kind of false. The reason why, especially in short term or people who day trade or quickly buy and sell stocks, the reason it looks like gambling or the reason it feels like gambling is because if the market works well, that price that the stock is right then should be a fair price for it. It shouldn't be overvalued or undervalued. It should be exactly what a decent price is for that company. So if you're buying it at whatever the market price is, the only way that it can go up or down is by random chance or by unknowns. So if I buy a stock at $2, I don't know tomorrow, is it going to be worth more than $2 or less than $2? If that's a fair price, it could go either higher or lower. It shouldn't be predictable. If it was predictable, if I already knew that a stock was worth $3 or $4 and it's trading at $2, and the market agreed with that, it would immediately go to $3 or $4. There wouldn't be this big adjustment that would need to be made. It would be instantaneous. The market would adjust and it would go back to a fair price. That is not always the case. Some people will argue they're buying a stock because they think it's cheaper than it should be, or they're selling a stock because they think it's more expensive than it should be. But really, if the market is working properly and you have millions of people all kind of arguing, how expensive or how cheap the stock should be, it should be at a point where no one can predict. It should be at a point where, we're not sure, is this going to go up or down any further from this point, because that is what is the definition of a fair market value. And so people who are in for a very short term on a stock, like only a couple of days or only a couple of months, it's going to just vary up and down based on what, the change in the general market thinks. If people start thinking it may be worth a little bit more, but it will be very hard to discriminate those random changes versus random chance. I would say when you're really valuing stocks or when you're using them as an investment, you should be looking long-term towards growth, that stock relative to the market. But a lot of times it's hard to get someone who's really good at picking stocks. And the whole reason for that is because if the market is working efficiently, all stocks should be priced fairly based on their risk and their return. If something has more, one of the principal fundamentals that the stock market runs on is risk and reward. You should be getting a certain amount of money returned to you based on how risky a particular stock or investment is. So one example is like a stock that is guaranteed to get a 2 or 3% return is going to be hopefully a very low risk stock, versus a stock that you think you can double your money on. That intrinsically is going to be a much riskier stock that has a bigger variation in its price. It's got more of a chance of going down. And what most people will do, most people who are investing, they analyze the risk. How much can I potentially gain? How much can I potentially lose? And then based on those factors, they will drive a price up or down relative to those risks. And so if it is at a fair market value, it theoretically shouldn't matter what stock you're purchasing if it's an efficient market, because all the stocks will perform, or should perform theoretically, about equal to their risk. Because if they didn't, people would sell them, drop the price lower, and then the price would it would even out to the point where now it is a fair price for the risk that's could be gained from it. And that's why a lot of people have difficulty, or a lot of people will do all these kind of predictive patterns, and they'll try to do a lot of analysis on stocks to try and say, is this going to make more money? Is this not going to make more money? But the problem is, if the market is working well, none of those will be any different than random chance. And this is why a lot of times they've done studies on people who actively trade or people who are specialists with stocks versus just random chance. And it's incredibly hard for people to actually beat what happens with the market in general. If you were to pick randomly versus actually having someone skilled or paid to buy things, there shouldn't be a big difference, because if the market was working well, there wouldn't be a trick to it. There wouldn't be some secret to be able to beat the market. Now, there's plenty of people who will make claims that they could beat the market. There's plenty of people who will try to, sell a system or push their way of thinking. But really, I would say it's more about understanding what an individual's wants and needs are for investing. If someone wants to be almost gambling and want wild returns, you're also going to have wild risks. So it's deciding, do you want huge risks and huge rewards, or do you want kind of low risks and low rewards? That's probably more important in terms of investing than what specifically people are trying to invest in. Now, there's more things like global trends, certain sectors that you're putting money on. But I would say for most lay people, most people who are not buying billions of dollars worth of stock, there's probably not going to be a huge difference in terms of what you purchase. It's more of a difference in terms of how much risk you're willing to take on and how much reward you're looking to get. I would say that's a pretty good intro to it. If people are interested in this topic or like this, or want me to go more in depth into the stock market, please, let me know. I'm more than happy to do another lecture, another talk on it. Or if there's another topic that you all are looking for, like what happens at death, physics, medicine, psychiatry, psychology, or any scientific, literal, biblical, any kind of topic, we can always do a more factual-based discussion on it, or more fact-based lecture on it. With the church, our whole point is trying to spread truth, trying to get people to understand reality and what things are and how to use them to their advantage. So we could give lectures on just about any topic and kind of include that. So if there is a topic that you all are looking for, we'll be more than happy to try and discuss if we can make a specific lecture for that topic. I will see you all next week. Thank you for tuning in, and you all have a great day. Bye-bye.